From the gas station to the grocery store, high inflation has been on everyone's mind. Inflation is, to your finances, as Ronald Reagan once said, as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. Inflation could hurt your cash flow, inflation could throw off your budget, and it could cause the prices of the stocks and bonds that you own to fall, and sometimes precipitously. It could cause you to lose money in what you have just sitting in cash at the bank. What can you do? You might be surprised. You could actually do a lot. I'm Eric Greschner with Regatta Research and Money Management, and I'm going to share with you tips on what to do in a high inflation environment, along with a checklist and a flow chart that I've put together for you that I think you'll really enjoy. Let's just jump right in. We've got a lot to cover, so let's get started. Managing your cash flow during high inflation regimes. Here are 8 tips on what to do. Number 1, update your living expenses. You may find that your personal expenses may have changed relative to the general now higher costs of inflation. For example, your rent, your grocery bill may be much higher than you budgeted a year or 2 ago. Update your budget to reflect the higher prices that you're currently paying so you're not blindsided if you wind up finding out that you have less money than you did before. How much you have an emergency fund may also need to be increased. As a general benchmark, you typically need 3 to 6 months of living expenses. That may need to be increased if inflation has caused your budget to go up. Look for additional ways to save money. For example, consider making annual payments rather than monthly ones. If you go the farmer route, sometimes you can often get a discount. Consider buying staple goods that you need every day in bulk. You may consider temporarily reducing or even delaying unnecessary expenses so you improve your cash flow. Review any important upcoming purchases you had planned that may be subject to price increases, and be open to consider potentially moving those prices forward to lock in a lower price today. If you're working, you may also be concerned about the ability of your earnings to keep up with inflation. If so, consider ways you might increase your income. These include asking your boss for a raise, changing jobs for potentially higher pay and greater benefits, or best of all, invest in yourself. Consider developing new skills, pursuing additional credentials so you could command higher pay. What to do if you're retired? You may rightfully be concerned about your retirement income's ability to keep up with inflation. If that is the case, be mindful that unlike many other retirement income sources, Social Security benefits have what is called a COLA, or built-in cost of living adjustment, that can help offset the effects of inflation. This is one of the very best reasons that Social Security is one of the top cards that you could play in an inflation regime. And always remember that the longer you wait to take Social Security, oftentimes the better. Consider delaying or repaying and delaying if you've already started your Social Security benefits. This will have the ability to increase both your overall income and the level of that income that is subject to COLA. This will allow you to better protect yourself against inflation. You may want to add to the investment menu to consider purchasing a no commission annuity, or even changing or replacing annuity if applicable, but doing it with an increasing income benefit rider as an inflation hedge. However, if you do decide to go this route, keep in mind that the increasing income option starts lower, but eventually over time can exceed the fixed income option. Make sure that you factor in your health and longevity as well when ultimately making the election. Be careful about increasing portfolio withdrawals that you're using for income during periods of high inflation, especially if asset prices have recently fallen. Instead, consider ways to reduce taking money out of your portfolio by exploring other options that could be used to increase liquidity and or generate additional income if needed. For example, consider a reverse mortgage, a home equity line of credit, or even cash value in a life insurance. There are different portfolio strategies that may need to be implemented, or even current ones that may need to be modified as well in a high inflation regime. I'd like you to be particularly aware of increased levels of interest risk that can be associated with bonds during high inflation regimes. Inflation makes interest rates go up. This in turn makes bond values go down. To reduce some of this risk, it's prudent to consider putting more towards bonds with shorter maturities. This is also called durations, while at the same time always being mindful of the difference in yield between long and short duration bonds. Series I savings bonds, these are also called I bonds, are what are called TIPS. And these stand for Treasury Inflation Protected Securities, or also options to consider. Both of these can potentially act as inflation hedges to the portfolio. However, like every investment out there, they're not perfect. They do have certain limitations. For example, inflation bonds only allow you to invest very limited amounts every year. You could also only purchase them direct from the US Treasury. They have holding period requirements as well, and early liquidation penalties. And there's also two components built into the yield. One is fixed, the other is floating, means that it goes up or down with inflation, and it's reset periodically. So even though if it's very high right now, the inflation rates can actually the rates that paid out can decline over time, so that high rate you're getting now in the event of a recession can go down as well. So again, they're useful, they give you a tool, but they're not perfect. To reduce price volatility in your bond portfolio, certificates of deposit or an option, or what are called multi-year guaranteed annuities. That's a mouthful. They typically mean fixed annuities. These two in conjunction can really reduce the volatility of the portfolio. However, if this is an option, I'd like everyone to be aware of the limited flexibility for penalty-free withdrawals from these. The latter, just for example, typically only allow 5 to 10% per year in penalty-free withdrawals. CDs, of course, often have early withdrawal penalties as well. I typically recommend a laddering strategy for many core bond portfolios. This can be an effective tool to help mitigate interest rate and reinvestment risk. And some people are not familiar with what a bond ladder is. It's simply a portfolio of individual CDs or individual bonds that mature on different dates. For example, say you have $1 million, you may have $100,000 in bonds for year one, another $100,000 for year two, and then another $100,000 for year three, and so on. The strategy is designed to provide current income while minimizing exposure to interest rate fluctuations. Spreading these maturity dates out can be very useful to try and prevent timing the market and interest rate risk. Also, staying disciplined and reinvesting the proceeds from these bonds using the ladder can be very effective in helping you ride out interest rate fluctuations. Just like any strategy, none is perfect. There's no silver bullet with anything. There are challenges with laddering and limitations. It takes an investment of time to do it the right way and maintain it on an ongoing basis. In addition, consider maintaining or increasing, if appropriate, your exposure to other asset classes. This can include real estate, commodities, private credit with a floating rate that can be better positioned to keeping up with inflation as opposed to a fixed rate. And finally, review your cash holdings on an ongoing basis. In general, you want to be careful about holding too much cash during periods of high inflation. It's being eaten away, and you're not protecting the value of your dollar. Another tip, be careful of where you keep your emergency fund. If it's particularly low yielding, you may be having losses after inflation, and in some cases, sizable ones. So be sure to explore other options such as high yield savings and checking accounts, short-term CDs, and so on. They can offer better growth potentially on your idle cash. Now, what do you do about debt in high inflation regimes? Well, one thing to be particularly aware of is variable interest rate risk. These are sometimes on home mortgages. They're typically associated with home equity lines of credit. These are ones that are not fixed. They change and can rise, in some cases fairly significantly, during periods of high inflation. It's critical to make sure you understand just how that rate is calculated, and secondly, what is the extent that inflation can cause your interest rate risk to increase. So what we typically suggest doing is consider paying down variable interest rate debts first in an inflationary regime, or refinancing them to a lower fixed rate. That way you have certainty and a lower debt service cost. Third, potentially look at locking in now for lower interest rates. If you're thinking about financing any large upcoming purchase you had planned, and if interest rates are going to be going higher in the future, you may want to go ahead and consider locking that in sooner rather than later. What about tax strategies during periods of high inflation? Rhetorically, have your taxable investment accounts been experiencing increased levels of volatility due to high inflation? If so, a good tip is to consider rebalancing your portfolio if it's declined at a lower tax cost. And what do I mean by that? Specifically, consider harvesting short-term losses or selling securities in taxable accounts that are lower prices now. You could reduce your capital gains that you do. Keep in mind this is just one component of the overall picture. Taxes are important, but what is the valuation of the stocks? How do they fit in the portfolio? Are also countervailing virtues that need to be balanced in. Taxes are important, but you don't want the proverbial tax dog to wag your entire portfolio and strategy. Just one variable among many to consider. If you do go this route of harvesting short-term losses or selling securities that have decreased in value in order to reduce your capital gains, be mindful of what are called wash sale rules, as well as the $3,000 ordinary income offset on capital gains losses. You may also need to review your current and anticipated tax brackets in the light of high inflation and determine whether your income may have increased to a greater or perhaps a lesser extent to your marginal tax brackets, and consider how that may affect your effective tax rate. Also, certain tax strategies such as favoring pre-tax Roth contributions moving forward may need to be reconsidered as well. Also, be cognizant of the areas of the tax code that did not receive inflationary adjustments under current law. These include Social Security taxability, what are called net investment income tax and SALT limitations may also come into play, and consider how these may impact tax strategies moving forward. Also make sure you review any potential Roth conversion opportunities in light of high inflation. Periods of high inflation may present opportunities to convert some assets to Roth accounts at lower prices. There are a number of miscellaneous items I'd like you to consider as well that don't fit into these broad categories, but are still effective tools to manage your overall nest egg in these inflationary regimes. You may need to reconsider any of your financial goals, such as retirement planning or your risk tolerance in light of high inflation and what it could do to certain asset classes. High inflation can literally be like kryptonite to stocks and to many bonds, particularly technology stocks and financial stocks. Inflation could actually help many commodity stocks. So it's not an across the board negative, and there are opportunities. You just need to know what you're doing and reposition that portfolio properly. Second, you may need to reassess your life and disability insurance coverage in light of high inflation. For example, you may need to factor in the risk of increased living expenses and or the need to replace higher income, and your life and your disability income insurance may not adequately cover your needs if you should die an untimely death or become disabled. Review your ability to add or even utilize existing inflation benefit increase riders associated with your policies if they are available, and they're not always available, but it's just prudent to check those and make sure that you're covered in every way possible. You may also need to reassess the coverage amounts for any insurance policies such as homeowners, renters, or autos in light of high inflation as well. For example, what is the effect inflation may have on the replacement cost of your vehicles? Just look how much the cost of new and used vehicles have risen over the last few years. Home, vacation, rental properties, or other goods are also susceptible to it as well. Here's the bottom line: review your coverage amounts for all your assets and make sure that they're still adequate for what you need. Finally, make sure you don't forget to review your gifting and or estate plans in light of high inflation. Consider the impact that inflation may have on your existing plans for transferring assets to the next generation. On behalf of the Regatta team, thank you for joining me for this educational video. We've also worked to put together a 3-page flowchart for you that lists all the items discussed in this video. This is emailed, of course, to all of our Regatta clients. But if you're not an existing Regatta client and would like a free copy of the flowchart, just email me at eric@regattaresearch.com. That's ERIC @regattaresearch.com, and I'll gladly send that out to you. If you have any questions, please let me know, let our team know, and we're going to make sure that we'll take care of you. We can be emailed at info@regattaresearch.com. If you enjoy this video and you would like to learn more about investing and about financial planning, and you haven't done so already, please follow me on Facebook and Twitter, in my YouTube channel. Thank you very much for joining me.